All right, so today what we're going to do is build a playbook. Think of it as a roadmap drawn from the absolute greatest minds in finance, and it's designed to guide you on the single most important financial journey of your life. Let's dive in.
Okay, but before we take even one step, we have to answer the most fundamental question of all. It's one that every single person with a dollar to their name has to confront. Are you an investor or are you a speculator? Now, I know it might sound like a simple question, but your answer defines every single decision you're going to make from this point forward.
And for the answer, who better to ask than the father of value investing himself, Benjamin Graham. He gave us this timeless definition. An investment requires 1. Thorough analysis. 2. It promises that your initial capital, your principal, will be safe. And 3. It offers an adequate return. Not spectacular, not lottery winnings, just adequate. Anything else, from day trading hot stocks to chasing the latest crypto craze, that's speculation. And make no mistake, those two paths lead to very, very different destinations.
So here's the game plan for today. We'll start at the crossroads, then we'll build the right foundation for our mindset. After that, we'll map out the entire market and then go on the hunt for great companies. We'll learn how to master risk and finally bring it all together so you can forge your own path. All right, first up, the investor's crossroads. This is that first critical moment where we make a conscious choice. Are we going to follow a disciplined process or are we playing a game of chance? Section 2, the foundation. So once we've chosen our path, it's time to build on solid ground. Because before you ever look at a single stock chart, you have to get your mind right. The biggest difference between the wealthy and everyone else, it's not the money they have, it's how they think about money. Robert Kiyosaki, in his classic book, Rich Dad, Poor Dad, called this the rat race. And it's this cash flow pattern that honestly traps millions of people. Think about it. You get a paycheck from your job, your only source of income. That money immediately flows out to cover taxes, the mortgage, car payments, you name it. And as your income goes up, so does your spending, right? It's this endless cycle of working harder and harder just to stay in exactly the same place. But here's where the wealthy do something completely different. They flip that model right on its head. Their income doesn't just get eaten up by expenses. Nope. They channel it into one thing, and one thing only: buying assets. And those assets, things like stocks, bonds, real estate that pays you, they generate new streams of income. And what do they do with that new income? They use it to buy even more assets. It's not a trap, it's a powerful wealth-building machine. This leads to a really simple, radically simple, new definition of things. For just a minute, forget what your accountant told you. An asset puts money in your pocket. A liability takes money out of your pocket. That is it. That's the whole game. So a stock that pays you a dividend? Asset. Your car that needs gas and insurance every month? Liability. By this logic, even your own home is a liability because it's constantly taking money out of your pocket. The investor's goal is dead simple: acquire assets and avoid liabilities. Okay, mindset is locked in. Now it's time to actually look at the market. But where do you even start? It's huge, it's confusing. The trick is to use a top-down approach. That's kind of like looking at a map from 30,000 feet up in an airplane before you decide which city you want to visit. And this top-down approach is actually pretty simple. It breaks down into 3 logical steps. First, you get a read on the broad market. Is the general trend up, a bull market, or is it down, a bear market? Second, you identify the strongest sectors. You follow the money. Where are the big institutions putting their cash? And only then, as the very last step, do you zoom in to find the best individual companies inside those strong sectors. This brings us to a really key concept called sector rotation. It's all about watching where the big money is flowing. See, when big institutions get nervous about the economy, they pull money out of cyclical sectors, stuff we buy when we're feeling good, like new tech or a vacation, and they park it in defensive sectors. These are the companies selling things we need no matter what, like toothpaste, medicine, or electricity. For instance, think back to the start of the pandemic. Money rushed into healthcare and consumer staples, while airlines and restaurants got crushed. Understanding this rotation tells you how the smart money is feeling. And on top of that, there are also these predictable seasonal trends. Yeah, just like the weather, the market has seasons. For example, everyone knows the fourth quarter means holiday shopping. Well, historically, this creates a nice tailwind for retail companies, the shippers like FedEx and UPS that deliver all those packages, and of course, the tech companies selling the newest gadgets. Now, it's not a guarantee, but being aware of these patterns can give you another little edge. All right, we've got our mindset right, we've mapped out the market, now it's time for the fun part,
Let's go hunting for those wonderful individual companies. And to do that, we're going to borrow the playbooks from the greatest investors of all time. We have to start with this piece of wisdom from Warren Buffett because it was a huge shift in thinking. See, the old way, from his mentor Ben Graham, was to find just okay companies that were trading for dirt cheap. They called them cigar butts. Buffett's big insight was that the real life-changing money is made by owning high-quality businesses for a very long time, even if you have to pay a fair price for them. It's about quality first, price second. Next up, the legendary Peter Lynch. He basically taught us that you can't just throw all stocks into one bucket. They're all different. He broke them down into these 6 categories. Is it a slow grower, like a utility company you buy for the dividend? Is it a stalwart, like a Coca-Cola that gives you reliable growth? Or is it a fast grower with huge potential? You have to know what kind of story you're buying into before you can even begin to analyze it properly. So how do you find these companies? Well, Buffett's advice is surprisingly simple. Stay inside what he calls your circle of competence. And guess what? You already have one. If you're a doctor, you understand healthcare companies better than most analysts on Wall Street. If you're a teacher, you know the education tech space. Your biggest advantage doesn't come from some complex spreadsheet. It comes from what you already know in your job, your hobbies, and your daily life. Start there. Okay, this is one of my favorites. It's a powerful little mental model from Buffett for finding the top dog in any industry. It's called the silver bullet test. Just imagine you could ask every CEO in an industry, if you had one silver bullet to eliminate any one of your competitors, who would you choose? The company whose name keeps coming up, the one everybody else is scared of, that's your winner. That's the king of the jungle. Okay, so even when we find that amazing company, we still need a safety net. And this brings us to Benjamin Graham's single greatest contribution to investing, the margin of safety. It's a simple idea. First, you do the work to figure out what a business is actually worth, its intrinsic value. Then, you demand to buy it for way less than that number. That discount, that gap between the price and the value, that's your margin of safety. It's the cushion that protects you if you made a mistake, if the economy tanks, or if you just get unlucky. So we've covered mindset, we've covered market analysis, we've covered picking companies. But there's one pillar left, and honestly, it might be the most important one. We have to talk about risk. And here's the twist. The biggest danger in investing, it's looking right back at you in the mirror. This quote just changes the whole game, doesn't it? We're all taught that risk is something out there, a volatile stock, a market crash. But the real risk, it's internal. It's thinking you know more than you do. It's panicking and selling at the absolute bottom. The risk isn't in the stock, it's in you. It's in your behavior. And that's actually great news because it's the one thing you have 100% control over.
So, how do we manage ourselves? Well, we just follow a few simple, intelligent rules. First, we admit we don't know everything, so we diversify. Second, we hunt for what are called low-risk, high-uncertainty situations, where the downside is tiny, but the potential upside is huge. Third, we're patient. We only bet big when the odds are stacked way in our favor. We always have an exit plan before we buy. And finally, we are terrified of leverage, because we know that anything multiplied by 0 is 0.
And here we are. We've gone all the way from that fundamental choice, investor or speculator, through building a wealth-focused mindset, to mapping the market, hunting for great companies, and finally, mastering our own behavior. Now it's time to put it all together. I want to leave you with one last kind of provocative thought that ties this all together. See, most people look at the market's crazy mood swings, its irrational fears, its greedy manias, and they see danger. But the intelligent investor, they see it completely differently. They see all those flaws and biases of the crowd not as a threat, but as the single greatest opportunity out there. The takeaway, your greatest profits are found when you exploit the irrationality of others. So there you have it, the playbook, pulled from the best minds to ever play the game. The principles of mindset, of analysis, of risk management, they're all yours now. The only question left is the same one we started with. But now the answer is up to you and the actions you take. What kind of investor will you become?